Evans and I are pleased to be here to answer your questions about today's interest rate announcement and our monetary policy report. Before turning to your questions, I'll offer some insight into Governing Council's deliberations. Now, not surprisingly, the worsening global situation was the primary issue. Economic forecasts have been marked down further in most countries, largely as a consequence of the escalation of trade actions and uncertainty around what may be next. Heightened uncertainty about future trade policies is directly reducing business investment, and there is a risk that this will spread to households as well. Now, these consequences can be buffered through easier monetary policy, and many central banks have recently eased in response. However, we need to remember that tariffs and trade restrictions will work over time to permanently reduce potential output everywhere, while raising the prices of consumer goods, a stagflationary scenario. Monetary policy can only do so much about these elements of the shock. Le Canada n'est pas à l'abri de ces évolutions mondiales. En effet, le Canada a été un des premiers pays à sentir les effets de l'incertitude liée aux politiques commerciales, puisque l'ALENA a été la première cible de l'administration Trump. Cette incertitude pèse sur les investissements au Canada depuis 3 ans. Ces vents contraires ont empêché les taux d'intérêt canadiens d'augmenter autant que les taux américains en 2017 et 2018. Cela dit, alors que d'autres économies subissent de plus en plus les conséquences de la guerre commerciale, une deuxième série d'effets vient toucher le Canada. On voit nos exportations et les prix de nos produits baisser. In today's updated projections, we are forecasting both exports and business investment to contract in the second half of this year and to recover only moderately in the next 2 years. We can see a wide range of indicators pointing to these effects in manufacturing, in mining, in rail transportation, in our Business Outlook survey, and in the quarterly reports of bellwether global companies. While we've had these secondary effects in our forecast for some time and have increased them in our latest projection, these are mostly judgment-based, and the situation could worsen. Accordingly, we present a deeper analysis of this downside risk in today's MPR in Box 3. Now, let me just note that the biggest effect for Canada of a more negative global growth scenario would be a steeper drop in commodity prices and, as in 2015, a significant depreciation of the Canadian dollar. In contrast to these adverse global developments, the Canadian economy is demonstrating resilience overall. L'économie continue de créer des emplois à un rythme solide. Le taux de chômage est près de son creux historique. Beaucoup d'entreprises disent souffrir d'une grave pénurie de main-d'œuvre qualifiée. Et la croissance des salaires a augmenté sensiblement ces 6 derniers mois d'environ. Après s'être ajusté aux changements apportés aux politiques de logement entre 2016 et 2018, le marché de l'habitation se redresse clairement. Ce marché est encore alimenté par des taux d'immigration relativement élevés. Enfin, les dépenses de consommation ont assez bien résisté en moyenne, et ce, grâce au solide marché du travail et au bas taux d'intérêt, même si le taux d'épargne augmente légèrement. At the same time, energy-producing regions continue to struggle as the full adjustment to the decline in oil prices back in 2015 is not yet complete, and transportation constraints are making the situation worse. You may recall that back in 2015, we said that the full adjustment would take up to 5 years, that even with lower interest rates and a lower dollar, as well as fiscal stimulus, the adjustment to such a large shock takes a long time. It's painful for individuals, as it involves extended layoffs and possibly interprovincial migration, which is costly for all concerned. All this adds up to a complex outlook for Canada, with considerable variation across regions and sectors. The strong labor market points to sources of growth, such as information technology and other professional services, tourism, education, healthcare, financial services. Some of this growth is being offset by negative effects coming through business investment and exports, particularly in manufacturing and in the resource sector. On the whole, however, it appears that our economy is still operating close to capacity, but probably with a modest amount of excess supply. The Governing Council agreed that, all things considered, this excess supply is probably not pervasive. Furthermore, our situation differs from many other countries in that inflation is at our 2% target today and projected to remain very close to target, despite the presence of modest excess supply. However, we acknowledge the downside risks, as set out in our alternative scenario in Box 3. Governing Council also devoted some time to a discussion of the evolution of financial vulnerabilities in Canada. We've been encouraged by developments since the enhancement of the mortgage stress test, as there has been a significant decline in new mortgages above 450% of disposable income. Further, we've not seen evidence of froth in major housing markets for some time now. However, the recent strength in many housing markets across the country is a reminder that we'll be carrying high levels of debt for a long time, despite a constructive evolution of vulnerabilities. So it's with this context in mind that Governing Council considered whether the downside risks to the Canadian economy were sufficient at this time to warrant a more accommodative monetary policy as a form of insurance against those risks. And we concluded that they were not. In this setting, we discussed whether such insurance may come at a cost in the form of higher financial vulnerabilities and possible consequences for the economy and inflation in the future. Now, we agreed that the new mortgage rules in place limit this cost, but the situation will require continuous monitoring. Moreover, the fact that inflation has been on target and is projected to remain near target means that we can weigh the upside and the downside risks to inflation more symmetrically. Le Conseil de direction est conscient que la résilience de l'économie canadienne sera de plus en plus mise à l'épreuve en raison des conflits commerciaux et de l'incertitude persistante. Au moment de considérer la trajectoire appropriée de la politique monétaire, nous allons surveiller dans quelle mesure le ralentissement mondial se propage au-delà de la fabrication et de l'investissement. Governing Council is mindful that the resilience of Canada's economy will be increasingly tested as trade conflicts and uncertainty persist. In considering the appropriate path for monetary policy, we'll be monitoring the extent to which the global slowdown spreads beyond manufacturing and investment. In this context, we'll pay close attention to the sources of resilience in the Canadian economy, notably consumer spending and housing activity. We'll also be watching for any changes to fiscal policy at the federal level now that the election is behind us. And with that, Senior Deputy Governor Wilkins and I will be happy to take your questions.
All right, we'll start the question period. As usual, please, one question, one follow-up. Kelsey Johnson, Reuters.
Hello, Governor, Deputy Governor. Kelsey Johnson with Reuters. So with growth running below potential for both this year and next year, how close is the bank to cutting rates?
Well, I can't summarize it any better than I just did. We estimate that given the growth slowdown that we have right at this moment in the second half of the year, that we're opening up a modest output gap somewhere between 0 and 1%. The middle of that range, say 0.5%, is the kind of the point estimate. That is, it's not something to be ignored, especially if more downside risks appear. But in this context, with our forecast still keeping inflation very close to 2%, like a tenth or two out of line here and there, it's a very minor kind of development on the inflation front. So that puts us in a position to be able to weigh the risks in their totality. And as I said in my opening remarks, to not take out an insurance cut, as some have called it, in this setting, given that we are there and that there would be costs associated with that.
As a follow-up, how has the outcome of the election with the minority government factored into the bank's decision? Is the bank considering that in any way or see any concern around that?
Well, that makes no difference to our analysis here at all. Of course, we act completely independently with our mandate, and it's all about what's the inflation forecast. And that is why I mentioned at the end that if the fiscal line in our forecast changes because of, in the post-election period, then that would be one thing that would need to be taken into account the next time we do a forecast.
Greg Quinn, Market News International.
Good morning. You're perhaps a bit of a loner now in the G7 with a higher rate than those other nations, and Canada's economy long thought to be a trade-dependent economy. What is it that's able to carry us through a global trade war?
Well, we've made it clear, I think, both in the statement and the monetary policy report that we are not an island. We are not immune to these global developments, but we think we're in a good position to cope with whatever comes our way, given that inflation is on target and unemployment is near an all-time low. Healthy and fit people can still get sick, but they recover more quickly when they do. And I just kind of characterize the Canadian economy as overall in that situation, allowing for the fact that it's not universal. There are, of course, as I mentioned, significant regional and sectoral differences across the economy. But in that context, I think we are in a global setting where, in fact, many of our borrowing rates have gone down with global interest rates through the global bond market. And so we are benefiting from that in terms of easier conditions for people renewing their mortgages and, in fact, negotiating new mortgages. So that's already a factor which is a consequence of that trade war and is influencing things. It also reminds you that there's a lot of talk about divergence, but actually what has occurred is more of a convergence. That is, U.S. interest rates have come down to about the same as our levels because they went up farther in the first place. So I would say we are kind of converged in this situation right now, and our outlook for the two economies is not that different.
Secondly, is the current rate still providing stimulus to the Canadian economy given this outlook?
Well, absolutely. There's substantial monetary stimulus in the system, and that, of course, has been a factor for a long time. So as we've said for, literally years, there are headwinds pushing against the Canadian economy. And until those headwinds dissipate, you won't see a return of all policy parameters back to what we'd call normal or, non-stimulative levels. We did think we were getting pretty close, previously, but then, of course, we had the trade war and as well some more issues with the oil markets and another shock from that source. So in that context, we're thrown a little bit, again, off track. But again, the forces that are pushing us back to normal are still there. But against them are these forces coming from outside the trade war.
Kevin Carmichael, Financial Post.
Good morning. Kevin Carmichael, Financial Post. Both of you talked about getting a good policy mix for years now. Others in the global context seem to have caught up where you've been starting a few years ago at least. That makes me wonder if, given the current setting, that fiscal policy would be helpful for you going forward. Would Canada benefit from fiscal stimulus at this stage?
Well, based on our meetings in Washington last week, that's almost a global statement that you just made, that that there's a growing concern that monetary policy has done most of what it's able to do, and that the shock that we're all facing is one that everybody is sharing. Perhaps you'd like to talk about the fiscal side and how it works in?
Sure. Well, you know very well, and I think we've said for a long time, we just take fiscal policy as given, but it's a very important given. And of course, whether it's a provincial budget or a federal budget, those announcements can change the bottom line in terms of growth. You'll notice that in the current outlook, the contribution from government goes from about 0.7 in 2018 down to 0.2 for 2020 and 2021. And so it can really move things. And that's why we watch it so closely. It has implications for the outlook and therefore for monetary policy. I think when we make our adjustments to the outlook, we also look at what else has changed over time. So it's never a all else being equal situation, and so we'll have to see what comes with the new government, and alter our outlook in consequence.
My second question relates to the exchange rate. Have you observed that the strength of the Canadian dollar is hurting the competitiveness of Canadian exporters?
Well, it's really, the Canadian dollar has been relatively stable in its primary exchange, which against the U.S. dollar. It's been in a pretty narrow range, slightly higher than it was a year or so ago. But the main thing that's happened is the U.S. dollar has been strong globally. And so while we've been fairly steady with the U.S., we've been appreciating against a lot of other currencies. And so it's on those margins where people are mentioning, well, it's a little harder to compete. We do know that as it says here, we expect exports to actually go down during the second half of this year. It's sort of an extraordinarily strong Q2, and so the average for the year still looks, I was going to say respectable, but I got to say it's a little soft, but at least positive. So my sense is that it can bite on certain margins, but as far as the competitiveness across the U.S., most of the conversations go to other things than the exchange rate. The sort of impediments or trade impediments or red tape or those kinds of other cost factors.
Globe and Mail.
Dave Parkinson of the Globe and Mail. Notice the summary graph of the paragraph of the statement dropped the use of the phrase that we are close to potential. Just wondering, I know that we don't like to hang ourselves too much on turns of phrase, but obviously the market picks up on changes of language. Wondering what the reasoning is to no longer include in the statement summary that we believe the economy to be close to potential, and what's the reasoning for dropping that, and also the significance?
Well, I think you just prove my contention that it's best not to say the same thing every time, because it means that people do get hung up on terms and whether they're there or not there each time. So as I think I've told you many times, we start with a blank page and tell a new story based on the new data and what we've observed and what our deliberations were about. I did mention in my opening statement that we are close to potential. We think it's somewhere between 0 and 1% of excess supply. The point estimate is very close to 0.5, or we say minus 0.5 to be exact, which is, I would say, it's not something to be dismissed. Okay, it's clear that we have moved in that direction. The question is, does it continue beyond that? So that's why we say we have to monitor the sources of strength, the sources of resilience in the economy, make sure that they hold up. And of course, it's always possible that we'll get some positive news on the trade front, which would give us some sort of a bounce in things like investment and exports. So I think I don't know, you read the newspaper as much as I do. What odds are there that CUSMA or USMCA gets ratified in the near term, and those odds are higher today than they were before, what it looks like to me. And the prospect of a possible deal, even if it's a phase one deal between the U.S. and China, I think would cause, uncertainty to stop rising, if you like. It's the sort of thing, it's the uncertainty path that's causing most of the problems with investment.
While you're on the topic of the possibility of a positive turn on the trade front, NPR obviously has a box that talks about the downside risk. There seems to be more emphasis on the downside risk here. You have talked in the past about at least a degree of symmetry of the risk on the trade front. Do you feel that we are now tilted more towards the downside than you previously felt?
Yes, we are, if only because time has passed and the negatives are already there. So we already can point to significant damage being done to the global economy from the trade war. And so starting from there, as opposed to where we were, say, a year and a half ago, we were starting with, statements, rhetoric, bluster. It could have been bargaining. It could be real. We didn't know. So it was definitely two-sided then. And then as the accumulated evidence grows, then you're starting from a negative position. So sure, if the uncertainty goes away and everything kind of goes back more to normal, then we'd expect to see a bounce. But it'll be some time before we were to make up the level cost that's already been paid. So there is an asymmetry to it now, for sure. The difference between July and now, the analysis in the box is pretty important, because in the box in July, we were analyzing a hypothetical augmentation or escalation of the trade war. More tariffs on all sides, and whereas what this box does is it holds tariffs and all the actions that have put in place, holds them constant, and simply analyzes the uncertainty channel, which, as we said over and over, seems to be the one that's playing the biggest. And the way that takes form is by companies feeling uncertain enough that they refuse to invest, spend money on growing their operations. And so what we did was we reverse engineered roughly what the gap is between the Fed dot plot and what market expectations are, and converted that into how much more uncertainty must be playing out in the marketplace. That's how the measure was created. And so that's how we scaled the shock. So that's why we call it a more, I say, realistic, if you like. It's not a purely hypothetical one. It's actually how much uncertainty market participants seem to have in their mind. And so we've run that through the models, and we've come back with, as you can see, a more dire scenario than our base case, but one where you can see all the channels operating and how the economy would adjust to it.
Toronto Star?
Hi, Heather Scott with Toronto Star. So just pulling together a couple of the things that you mentioned in your reports about Alberta and energy-intensive economies. So I think you're indicating that the Alberta budget, you see it as contractionary. And at the same time, you've got some indications that you see a slow recovery in the Alberta economy. Does the austerity that you see in the budget come at an appropriate time in that cycle, in terms of that economy needing some stimulus?
Well, we did analyze the effect of the Alberta budget for the purposes of just seeing what it would do to the bottom line for growth in Canada, and I'm not going to make a comment about the timing or the appropriateness of any particular measures. What we do see, though, in Alberta is still quite an adjustment in the oil and gas sectors that the governor talked about, that we knew was going to take a while. And then, of course, because of the transportation constraints, is a little bit more protracted than we had originally expected, say in 2015. That being said, on the investment side, we think that after the rest of the adjustments finish this year, that next year, because of new capacity coming online from Enbridge 3 and some other projects, as well as finding a new level, that investment should stabilize at a newer level. And it's important to just understand how much adjustment has already been made. It used to be 30% of GDP that investment, and now it's 15%. So it's quite a lot lower, but still an important part of investment in Canada. You know, on the export side, again, we expect from the non-energy point of view, or from the energy point of view, that growth to continue, but at a modest pace. When you look at other parts of the Albertan economy, you do see the housing market still adjusting. You see on the labor side that unemployment rate's still relatively high, and but at the same time, there's also signs of stabilizing. It's a pretty difficult adjustment, but we're happy to see that at least on the wage side, that wage growth picked up overall in Canada, and wage growth in those particular regions has also picked up to kind of meet the Canadian average.
Okay, thanks. And just to follow up on the timing thing, more generally, if you're to go back to your comments to Kevin about the policy mix. So if there's a need for stimulus and monetary policy is out of juice, when is the best time for revving up the fiscal policy side of things?
Well, I think from that's a important question, and I think it's more interesting than just when monetary policy is out of juice, because the mix of monetary and fiscal policy actually matters all the time, because when you stimulate the economy and you do it from the monetary policy side, what you're doing is you're stimulating credit growth, and often household credit growth, whereas when you're using the government expenditures, it's on the government side. And so there's a choice there to be made about which pile of debt you want to increase, and that's dependent on where you are in the economy. I think as well there's it's pretty widely accepted, at least in the global tables that we've been at, that fiscal policy has more bang for its buck when interest rates are low, and particularly when interest rates have run out of juice, as you put it. And so those are all considerations, and they're ones that I think fiscal authority needs to take on their own, because there are more objectives to fiscal policy than meeting the joint inflation target agreement that we have.
Wall Street Journal.
From the Wall Street Journal. The statement talks about the importance of Governing Council paying close attention to sources of resilience, consumption and housing. I'm wondering, given the past focus the bank has put on a rotation of the economy away from consumption and housing and toward exports and investment, where your view of that rotation currently stands. Is it on hold right now, given the global headwinds that Canada is facing?
So, yes, it's on hold, but the good news is a bunch of that rotation actually occurred back when we were talking about it. It's not as though it never occurred. Okay, it did. So if you just look at the charts in levels, you know, of how exports came back through that period, and investment too. But we've had a series of interruptions of that process. You know, the really big one being the oil shock in 2014-15. You know, almost to tell the story now, you have to take energy sector investment and exports out of the chart and see what's going on in the rest of the economy, because that is such a major adjustment that overshadows most everything else. But if we do that, what you see is plenty of signs that the rotation has actually occurred and that it continues. But it would be fair to summarize it right now as a bit on hold, because both investment and exports have slowed right down in light of the trade war. We are definitely we're in a two-track economy, which we've talked about certain phases through. It almost always have some features of a two-track economy, but just, you know, a couple of quick numbers, like the overall right now, we think the economy is growing at, say, 1.5%. Well, the service side of the economy is growing by 2.3 or 2.4%, whereas the goods side of the economy is growing is growing negatively. Okay, so and that of course would include the energy sector is an important part of that, but manufacturing, et cetera. So in terms of employment, it looks more balanced because we continue to have job creation across a much wider spectrum. And, you know, so over 2% growth in employment over the last year, which is terrific, and 2.6% in services, 1.3% in goods. So again, you can see the two tracks operating. And there's a fairly strong regional dimension to that, as Carolyn's been mentioning. So we're aware of all those disparities. It's just that in the aggregate, it comes together roughly at potential, just a little bit short of potential, and as I said, with inflation on target.
And you mentioned Governing Council discussed financial vulnerabilities.
Yes.
And the impact of, if there were to be an insurance cut, the impact on worsening those vulnerabilities. Can you speak to what extent concerns about financial vulnerabilities factored into the actual decision making?
Well, as I said in my opening remarks, which is in effect a record of the things that we spent our time on in deliberating, it was a significant piece of the discussion. We do feel that, first of all, the new stress test and other macroprudential changes have served pretty well to kind of get a situation into a more normal sort of behavior. And we were watching, as you know, for a while to see how disruptive that might be for the housing market. So the housing market, you know, had a weak year or so, but it's coming back across the board, and so that's all encouraging. Now it's important to remember though that those new macroprudential measures are a form of protection against future over excessive enthusiasm. Okay, so that of course that's a little bit untested, right? Because it's kind of the first time we've gone into a housing recovery with those new measures in place. So that's why we say we'll monitor that closely. But no doubt that in today's macroprudential environment, the cost associated with a so-called insurance rate cut would be lower than it would have been without those macroprudential things. So that's the base you start from. But we don't think it's zero or anything. You know, it's still possible, of course, to reignite a bunch of bidding wars and so on in the housing market, because as far as I know, not much has changed on the supply side. You know, but by having lower rates and good income growth, there's good demand, and immigration, there's good demand for housing. So it was an important part of the discussion. And in the end, we're comfortable where we found that the overall risk balance, that's just not just managing inflation risk, but the financial stability risks at the same time.
Any other questions? Yes, Canadian Press.
Sir, could you give us a sense of how close you came this time to cutting rates?
I don't know how to answer that, Andy. It's I mean, we as you can tell from the previous exchange, we definitely talked about what that would look like, and it's true that as an inflation targeter, you're looking forward, you're balancing the risks on the inflation outlook, and if the downside risks start to build up, that's when you start thinking that, you know, gosh, we should anticipate that. So far, as I said, we can clearly identify in the exports and investment this drag coming from the trade side, but at the same time we've got some pretty good lift coming in other parts of the economy, and so that's how those two things kind of tend to balance out for the time being until you see different data that convince you otherwise. On top of that, as I want to make everybody understand, we start that discussion with inflation on target. If inflation were below target, such as where we were back in 2014-15, then, and especially then when we had the downside shock from the oil price collapse, we could do the arithmetic around that shock. You know, we called a few companies. We knew how large that shock would be to the economy in dollars and how quickly it would affect. Whereas here we're talking something very intangible. You know, how do companies adapt to this trade frustration or trade uncertainty? Well, they don't usually just sit there. They do things, and so you have to kind of read the data and see how it's going as opposed to just doing arithmetic. So with that much uncertainty, I think the best solution here where we are is to hold firm and watch things develop. And as I said, because inflation's on target, it kind of gives you that ability to keep it symmetric.
The fact that the federal election was only a few days before this scheduled announcement, did that play a factor at all? Perhaps because the bank was quiet over that period, of course?
Well, you know, traditionally the central bank is usually quiet during an election period. I think that only makes sense. It avoids us getting dragged into the dialogue. I think that's an important thing. But no, obviously if the situation warranted it, we would have acted today. Or that would have been our preference to do. So, no, nothing like that.
Yeah, Bloomberg.
Hi, this is Shelley Hagan with Bloomberg News. Did the bank consider insurance cuts in September?
Well, in September, we didn't have a whole new forecast. We were, of course, if you'd asked me in September, we could have guessed which way the forecast was shifting, right? So, but you know, it's one thing to know unless a risk becomes obvious to you in that short time frame of 6 weeks. You're more inclined to say, I need to understand this better before I know whether, you know, because as Carolyn mentioned earlier, like, it's never just one thing that's changing. There's all kinds of things changing all at once. And so you want to figure out the exact proportion and how the risks have tilted really does require us using all of our tools. And that's a longer process. That's why we only do it every four times a year, every 3 months. So that's a big exercise and would be, well, first of all, it would be hard to do every time, but I think it would be kind of counterproductive because you actually need time to absorb new data and think about, to form those judgments. It's not a mechanical exercise like pressing a button. So the direct answer to your question is no. Certainly we could all see which way the winds were blowing, that the risks were beginning to accumulate on the foreign side, yeah.
So maybe the new revisions to the forecast kind of made you consider this?
So you get a new forecast in front of you, and you can see then, and then plus that extra case that's in box 3 kind of informs, well, okay, so what would the world look like if, say the forecast is wrong and it's a bit worse than we thought. Well, it's easy enough to imagine what it looks like if it's better, you know. But if it were worse, then that box helps inform that. And I just note that actually in that scenario, inflation stays within the bands on that scenario. Okay, partly it's for an unfortunate reason, which is that aggregate supply goes down as well as aggregate demand. So that if it was just demand going down, then there would be more downward pressure on inflation. But there's less downward pressure on inflation because of that stagflationary bit of the shock, because supply contracts permanently as well. So anyway, that's a really complicated thing to do just on the back of an envelope. That's why we need the tools all to be deployed, and the whole staff rallies around it. Okay.
Anybody else?
I feel like I should toss in a question about Libra and stablecoins since we've gotten through all the questions on the bank on the state of the Canadian economy. Do you want to sort of update the Bank of Canada's view on Libra and what appears to be a new urgency among global regulators about getting a handle on private stablecoins?
Well, sure. I'm delighted to remind you that we're a couple of years out ahead of that. So, and I happen to be sitting beside one of the world's foremost experts. So, so over to you.
So It's interesting how exciting these developments can be. And you're talking specifically about labor, but there's a whole class of crypto assets called stable coins, and that's part of that asset class. And what's exciting about it is the fact that these kinds of innovations can address what I think are important issues in global payment systems, particularly the cost of cross-border payments. If you're trying to do a remittance, you're here and you want to send money to the Philippines, well, it costs a lot of money. If you're in another country, not so much Canada, but in others where you don't have access to a banking account, you can't even make those payments. And so this idea of being more efficient and getting access is quite attractive. At the same time, we know that innovations never come without risk, and so when you balance that risk-reward, you have to take some of the risks associated with these types of innovations, including Libra, pretty seriously. And that's what the G7 did. You might have noticed there's a report that came out that Canada contributed to under the French presidency, which highlights the benefits but also the costs that we all know that are related to money laundering and terrorist financing, but also with respect to safeguarding the value of that stablecoin properly, as well as potentially getting in the way of monetary sovereignty of different countries. And so it's for that reason that that report concluded that any kind of innovation of that type would have to, and particularly Libra, would have to meet the regulatory requirements before it could go live. And I think that makes sense in terms of safeguarding, I guess, the system not for central banks, but for citizens of our country. Now, at the same time, I think it has put a spotlight on, well, how did we get here with inefficient payment systems and ones where we don't have access? And that's put the onus on central banks and major participants and the international network to do something and quite quickly, as quickly as they can, to address those issues. I think that work is going to be well underway. It's a priority for the G7. I believe it will likely be for the G20 and the related groups at the BIS and the Financial Stability Board. And Canada will be right there participating with it.
Thank you.